My guy?
Yeah, oh, there we go.
There we go.
Good morning and welcome to the March investment meeting. If everyone would just go around the room and introduce themselves.
John Dorsett, designee for control of Rattling Enterprise.
Good morning, Steve Meyer, CIO for the Bureau of Asset Management, as an invited guest.
Kimberly for Mayor items.
Italia Fazolino for Commissioner Newman.
Arthur Regner, PBA.
David Morris, PBA, present by invitation.
Marla Caterpillar Wilshire, for the invitation of the trustees.
Rob Appling, Wilshire, by invitation of the trustees.
Anthony Bradley, SBA.
Jeffrey Ward, DEA.
Robert Hackmeister, CEA. I also have the proxy for the LBA.
Andy DeSapro Miller, Police Pension Fund, present by invitation.
Kevin Holleran, Police Pension Fund, present by invitation. Jackie Denver, representing Commissioner Fish.
Nicole Giambrisi, Police Pension Fund, present by invitation.
Valerie Redhorst, Bureau of Asset Management, present by invitation.
Yes, and Valerie is a new Deputy Chief Investment Officer for Responsible Investment.
Nice to meet everyone.
Kate Visconti, alternate for Capilla Brandley.
Also present with us on the meeting are invited participants from the Bureau of Asset Management who will identify themselves if they speak, as well as the New York City Chief Actuary. John?
Sorry,
Oh,
John.
sorry.
Anna Russo,
I'm
Police
sorry.
Pension Fund, present by invitation.
And Marietta Juliari, present by invitation.
And I just want to note, we also have some additional consultants that are on Zoom, and if they participate, we'll ask them to identify themselves. Just want to put that on the record. If it pleases the trustees, we're going to move forward with today's agenda. Steve already took some of my thunder by introducing Valerie to everybody. So Val will be here for most of the meeting. It's only her second week on the job? Third week on the job. First time she's seeing a police meeting in action. So, if there's any questions, I'll ask her to kind of hold those until we, about process here, until we meet again and reconvene. But I think she's going to be a great asset to the fund, helping us stay on course with a lot of the initiatives that we've talked about here and that we continue to talk about at the board. The first item of the meeting is listening to words of wisdom. I don't see that here. I see Steve Myers is up instead. So I'm going to turn it over to Steve to give us the market update, and then we'll get into the executive session and discuss specific managers. So Steve, it's all yours.
Terrific. Thank you, John. And good morning again, trustees. I'm going to be very brief today. We've got 5 deals to get through and a lot of material, so we're going to skip the risk review today. I'm just going to give a very brief update on what's going on in the world and the economy. Is Donald or Wilfredo, you guys give the slide?
I am here, but I cannot share my screen for whatever reason, so I may need my esteemed colleague Wilfredo to help me out here.
Okay, John. Wilfredo, are you there?
This is our first meeting, I believe, since we've upgraded our computer system at the controller's office, so this may actually be a glitch associated with that. So just bear with us a second.
Terrific, Wilfredo. We can see if you just make perfect. Great. Slide 2, please. Great. Thank you, Wilfredo. Just to give you a quick update of what's going on in the world, inflation's actually moved up a little bit. It's been stickier than many people would expect, both here and abroad. But here in the United States, it's actually required the Fed to be on hold. So we saw Fed rate cuts of 100 basis points from September to December of last year, but they are on probably a prolonged hold until they get better insights into the inflation outlook and picture. On the next slide, just a quick look at that. You can see in white on the far right-hand side, inflation is measured by CPI year over year, moved up again from 2.7, 2.8, up to 3%. And core PCE, the deflator, is actually still steady at 2.8%. So just a reminder, the Fed's target for inflation is 2%. We're certainly well above those levels. On the next slide, just a look at where we are from an inflation standpoint. On the far right, you can see that those are the levels of inflation for the U.S., the Eurozone, and the U.K. Again, all pretty sticky and pretty steady at above 2%. Probably a little bit more problematic in the States, and I'll talk a little bit about why that is in a few moments. On the next slide, You may be hearing headlines or reading headlines or hearing people talk about stagflation. If you remember back in the 1970s, we had 2 oil price shocks. We had stagnant growth and high inflation, thus the term stagflation. I think the expectation, at least right now, is that we may see a slowing of growth and consistent or persistent inflation, which can be a little bit problematic, meaning the Fed would be on hold for a prolonged period. But again, nothing at this point is expected in the magnitude of what we saw in the 1970s. On the next slide, just a quick look at where unemployment is. Unemployment's actually been, and the employment picture in the U.S. has been quite solid. You can see the unemployment rate at just 4%, and the participation rate pretty steady at 62.6%. People in the U.S. are actually working in the economy. We get a fresh look at non-farm payrolls and unemployment this Friday. So we'll see what the outcome was for the month of February, again, in a few days. On the next slide, concerns today are about really the U.S. tariff initiatives being pursued by the current administration, and whether they may, or perhaps will or already are, stifling U.S. and domestic global growth. Again, with that sticky inflation I talked about, which is why, again, you continue to hear people talk about stagflation. On the next slide, just a look at where we are from a growth perspective. On the far right, you can see that we've actually added, Dan Haas has added a table on the bottom. U.S. GDP growth year over year through the fourth quarter was 2.3%. It's less than 1% in the Eurozone, a little bit more than 1% in the UK. Japan, a little below 3%, which is quite solid. And China came in at over 5%, but there's questions of whether that's sustainable or not. So again, sticky inflation, slightly to moderate decline in growth is spooking some of the investors around the world. On the next slide, the Fed is on hold, as I said, after 100 basis points in cuts in the latter part of last year. The Fed is specifically citing uncertainty around U.S. trade policy as an inflationary concern that it will keep them on hold for a while. I believe there are new tariffs being kicked in today for Canada, Mexico, and China, and we'll see how that whole process plays out. The thinking is that the initial wave of tariffs will probably be compromised lower, and I think that's why the market hasn't really overreacted to the concerns about today's imposition of tariffs. On the next slide, just a 30-year chart of where we were in terms of official interest rates. You can see really unchanged the Fed funds rate in the state at 4.5%, 4.5% for the Bank of England, 2.75 for the ECB. And again, the outlier here in terms of the other central banks cutting rates is the Bank of Japan, which has raised rates in the latter part of last year, coming up with a negative 10 basis point official rate. So again, positive news on that front. On the next slide, credit spreads remain very tight, and there's a real question as to whether lenders, such as investors, are being too optimistic about the potential for growth. Will inflation really come down and be contained? And what will be the behavior of default rates going forward, which have actually been pretty benign. On the next slide, just a quick look at some different things. You hear a lot of talk in Washington and in the financial markets around U.S. deficit spending and the national debt. Here you can see that the balanced budget is the red line up top. We last year ran a $2.1 trillion deficit, and our cumulative debt outstanding now is $36.2 trillion. The public debt outstanding is closer to $28 trillion, and that's about almost 100% or equal to the U.S. GDP growth per year. So not some great developments. We do need some more fiscal discipline in Washington to reduce a level of deficit spending. Another interesting fact, I say fun fact, but there's nothing fun or funny about this, is that the interest expense associated with our outstanding public debt in 2024 was $882 billion, again, just to pay the interest expense associated with that debt, versus defense spending, which was $874 billion. So at this point, our interest expense, our debt burden, is costing more annually than, again, defense spending. On the next slide, a look at credit spreads. In white on the bottom, you can see those are that's the extra yield you receive for investing in an investment grade corporate bond. It's at 87 basis points. I think it's probably more attractive than looking at Rob at 110 basis points or above. Credit spreads are really tight. That extra yield you're getting now for taking on credit exposure is lower, which means less attractive. And then for high yield in orange, you can see that credit spreads there are 280 basis points. We probably prefer that as high as possible, but 350-ish is where I think it's probably a little more compelling. So tight credit spreads, low defaults. We'll see if that continues. On the next slide, just to look at where the yield curve is. And the most recent yield curve from last week is up top in red. And that basically says, if you look at that, where the red is relative to the other bars, the blue on the bottom is from 2021. You're earning another 300 or 400 basis points in yield by investing in bonds. So it's been painful to get there in terms of the backup in interest rates and the decline in bond prices. But now your fixed income is actually generating more income consistently, which is positive. On the next slide, we've seen recently U.S. Treasury yields as a general matter moving down. In white, 2-year Treasury yields below 4%, and 10-year U.S. Treasury yields, which a lot of times will drive pricing, say, for mortgages at just under 4.20. Those are significant improvements in yield, meaning moving lower. Unfortunately, the reason for the reduction in interest rates and yields is because of concerns about growth and the growth potential, and whether, we'll see that stagnant growth and inflation persist. Next slide, let's skip, Wilfredo. Just a quick look at where we are in early 2025. U.S. stocks are actually lower, and they actually significantly underperform European stocks. So as of this morning, the NASDAQ 100 index was off almost 6%. European stocks pretty much across the board are up in the low to mid-teens, which is positive. Asia's been pretty much flat or mixed, and bond prices with the decline in yields have actually gone up, which has been positive. And you'll see that impacting your portfolio when we get to the monthly update in a while. Private equity, there's a lot of expectation or high hopes, as the headline suggests, for deal volumes to increase, a return of animal spirits, a lighter touch administration from a regulatory standpoint, and a pro-business administration will hopefully spur more deals. We'll see more exits associated with your PE holdings over time. Again, that remains to be seen. On the next slide, look at fourth quarter and actually returns kind of out the curve. Fourth quarter was challenging. Non-U.S. stocks, developed market ex-U.S. was down 7.5% in just 3 months. Emerging market stocks off 8%. You can see sort of in the middle there. We saw a significant backup in yields, which means bonds were lower. Again, that's been reversed more recently. And investment grade, because of the relatively high duration and the impact on the backup in Treasury yields, it was off 3%. So a little bit of a challenge in the fourth quarter. On the next slide, just to look at market returns. On the left-hand side, those are stock returns for the U.S., Europe, and developed and emerging markets. And I asked Dan to put circles around 2 big events where we saw the global financial crisis drawdown, which was significant, meaning the decline in values, and then the decline in values associated with the rise in interest rates that began in 2022. Typically, you'll see a 10% correction in the Russell 3000. The Russell 3000 is the proxy, but the Russell 2000 and the S&P 500, a 10% correction is typical every 2 years, probably due, and we'll see how that plays out. On the right-hand side, those are actually aggregate bond returns. You can see that those return streams tend to be more consistent. We did see that dramatic drawdown or reduction in value associated with the rise in interest rates from very, very historically low levels, below 1% to over 4% now. On the next slide, just some questions as to whether the current administration's policies will hurt the U.S. economy. The one thing I can say is that there's been a lot of volatility. Someone would call it chaos, but there's been a lot of change in a very short period of time with the new administration, and a lot of uncertainty associated with those changes. And obviously, we've seen that be impacted in the price of risk assets. The markets hate uncertainty, and what we're seeing right now in the marketplace is an increase in asset price volatility. On the next slide, again, no disrespect to Wilshire, this is a Callan slide, but this is actually one of my favorite slides. You can see over 20 years worth of returns, and it actually breaks down which returns at which asset classes at which returns over time. So if you look at 2024 on the far right-hand side, you can see that large cap equities had an unusual 25% return. Small cap equities up about half that at almost 12%. High yield delivered 8% returns, and on down, emerging market equities 7.5%, cash a little over 5% all the way down. And you can actually look for patterns, or really just look at, this is why you have a diversified portfolio. We never know what's going to wind up on top in terms of outperforming the other asset classes. So even though there's an increase in volatility and there is an increase in uncertainty associated with the change in administration, you have a diversified portfolio, an all-weather portfolio that should perform regardless of those circumstances. On the next slide, just to be efficient, let's skip the next couple of slides, Wilfredo. Sorry. Maybe slide 25. Just a look at the contribution of personal consumption expenditures to gross domestic product here in the States. So the Fed started raising rates significantly in 2022, 2023. They paused 24, and they cut the latter part of 24. What was interesting, even though you had a significant backup in rates beginning in March of 2022, the economy really didn't slow down that much, and U.S. consumption didn't slow down either. This may in large part have to do with coming out of COVID, and there was a pent-up demand for experiences, services, and goods, which we've seen play through. But again, the U.S. consumer has been quite resilient, exhibiting a willingness and an ability to spend money. On the next slide, a quick look at, despite, again, the hundreds of basis points in rate hikes in 2022 and 2023, U.S. GDP growth has been quite solid. Typically, we can talk about trend growth is around 2%. And you can see over the last couple of years, again, coming out of the COVID recession, that growth has been pretty strong, and more recently in the fourth quarter of last year at 2.3% above trend. Let's skip the next couple of pages.
We can through.
You sure, Joe? Actually, this is an interesting, so let's look at the inflation drivers on slide 29. Wilfredo, just tailwinds inflation and why people are more concerned about not just the stickiness of inflation, but the propensity of inflation to continue on. A lot of times inflation comes and goes, and you'll see as it trails off, a lot of times there's pent-up demand for higher wages, which causes a second wave of inflation. We also have in that the mix of the potential for increase in tariffs that are actually implemented today. Those are thought to be inflationary. And depending upon how inflationary, really is a function of how much of that increased expense is absorbed by the sellers or producers of products. Economic momentum is accelerating, which is a good thing. There are expectations again for returns of animal spirits, the deregulation, lower taxes, and potentially a more pro-business administration will spur more activity, more growth. Tariff fears, also the expectations of tariffs alone has caused inflation expectations to increase. And I'd say two other points that are driving inflation to some extent are high stock prices. People feel well, they've got more money and they're spending it. You can see that in consumer spending a few minutes ago. And high home prices are also powering consumer spending. So we'll continue to monitor inflation, and we'll see what the impact is on official rates as well as your long-term bond yields. When we skip ahead,
Steve, I got a question.
Sure, John, please.
So I get the high stock prices, but how much of that is somewhat artificial because we're in an era now where there's auto enrollments, so everybody's got, so a large percentage of the population has money going into some fund, usually an index fund in a 401k plan or whatever the prevailing plan is at their business. And then the index provider is having to buy more shares of certain companies in order to maintain pace with the index. How much of the high stock prices are artificial in the sense that they're created by legislation or initiatives that companies have undertook, and what's that doing to the real value of those companies?
Yeah, so John, I wouldn't say any of that's artificial because the money continues to come. You're absolutely right, though. The observation is a good one, that there's more money that comes in the market consistently, and it comes in over time as people get their paychecks, they allocate to their 401k plans. And I think that's all really positive. But the money, you're absolutely right, a lot of that does go into passive investments. And passive investments, you do have a concentrated stock market right now. We've seen, obviously, the
I'm not
fast.
against the index investment, to be clear.
Yeah, it's actually a really good way for individual investors to put money to work that will perform over time at a low fee. You're right, though, there's the concept of momentum in the markets. We have the Magnificent Seven stocks that have really kind of dominated, and they're over 30% of the S&P 500. Top 10 stocks are close to 36%. And it's a concentrated bet. But I don't necessarily think that's specifically because of passive investment. But you're absolutely right, John. If every dollar that went into the market went in passively, it would be a constant rise in the winners relative to the losers in a more concentrated stock market. Maybe skip to slide 33, Wilfredo. Just a quick look at the trade wars in the past. And this is actually the U.S. Economic Policy Uncertainty Index. And remember, markets hate uncertainty, but you can see back in 2017 or 18 and 19 when the current administration or the current president really initiated a number of his tariff policies, the level of policy uncertainty went up, again, which is disconcerting for the markets. And you can see on the far right-hand side, and very early into the new administration, the policy uncertainty is just incredibly high. And again, some of that has to do with the style of the current administration to move fast and to break things. But we'll see how that plays out over time. See,
It looks like it came down though towards the end of his first term.
It did because there's less uncertainty as the new administration coming in. He was running for re-election. I mean, there was still uncertainty, but around policy. Most of the policy changes that a new president makes is in the first 2 years. And you can see as you know, President Trump is serving his second term, so the expectation is he'll probably do things a lot faster in the first year or two of his administration. And I think we're seeing that. Maybe, Wilfredo, go ahead 2 slides to slide 35, and then I'll cut over to your performance. This is a fascinating slide. This looks at the where the U.S. in blue was the main trading partner for most countries around the world back in the year 2000. Now, as a reminder, China actually joined the World Trade Organization in December of 2001. And you can see, again, the U.S. was the dominant trading partner with most of the world now. Go forward 1 slide, and you can see how things have changed quite significantly. At this point, China is the main trading partner for over 120 countries around the world. Again, it has to do over a 20-year period of them joining the World Trade Organization, again, through 2020 to become the dominant trading partner for, again, most of the world. So those are things that I think the current administration is mindful of and some of the things that the current administration is trying to address. Well, Fredo, why don't we cut ahead to the police performance reporting on slide 41. So this is your plan through the end of the year. It's a little bit of a history lesson. It's backward looking, but you can see that the police plan for the fourth quarter actually delivered a negative return of just 0.4%. More importantly, again, I always try to counsel to focus on the long term. Your 10-year average returns have been 7.7%. Again, which is well above the 7% target that we currently have in terms of your actually assumed rate of return. On the next slide, just a different look at that. So if you're earning at 7.7% over an average over the last 10 years, you can see that you're above that 7% target. The 7% target is the orange line, and the blue line is actually the performance that the police pension plan is delivered. So again, you're above that watermark of 7%. And somewhat significantly over time. On the next slide, I'll look at your net public market returns by strategy. Again, in the fourth quarter of last year, again, some challenges outside the States. Developed market ex-US down 8%, emerging market stocks down 8.3%, and fixed income domestically was off considerably as rates backed up. Again, and a lot of that's reversed, and as I said earlier, and I'll talk about this a little later, the non-U.S. or the developed market ex-U.S., particularly European stocks, have dramatically outperformed the U.S. stocks so far this year. Skip ahead a couple slides to just maybe a look at fees on slide 46. Wilfredo? we're trying to get more clarity on this, and we want to show trends in terms of what the Bureau of Asset Management and our consultant is doing, and Wilshire is doing to reduce fees over time. So this is a snapshot. These are the third quarter, not the fourth quarter, but the third quarter fees you paid. That's almost $13 million. That's almost $51 million on an annual basis for public market asset management. And we are doggedly going through every single manager with a view of reducing the amount of fees that we pay, trying to be more strategic around active versus passive versus systematic or non-core. So I know Ed Berman and John Merceburg and Robert Fang are spending a lot of time on how we can reduce the fees and better position the portfolios for performance and outperformance over time. And the next a quick look at your private manager returns on slide 47. That's a better story. Obviously, real estate struggled a little bit with some issues around office coming out of COVID, but perhaps more recently because of the higher level of interest rates, there's a lot of maturities or maturity wall that occurs in 2025 that may impact the real estate sector generally. Perhaps more positively, if you look at September of 23 through September of 24, mostly green across the asset classes. Private equity up 8%. More importantly, since inception or about 10 years, that's up 12.5%. What I love about this slide is the steadiness of infrastructure, again, consistently delivering double-digit returns without a significant fallback, and we expect that to continue. Maybe not to the same extent, but still be a strong performer. Alternative credit, again, for 1 year, delivered almost an 11% return. Again, higher rates, even though credit spreads have tightened, that really help the performance there. And lastly, your hedge funds, which function as both a return driver and a volatility hedge, delivering almost 7% in that full year.
I have a quick question. So the infrastructure performance looks very strong.
It is.
This consistency is just amazing. I'm just wondering, is it a function of the infrastructure just space in general, or do we outperform on that basis?
I'd like to tell you it's because I've been doing such a great job for 30 months. The truth is, my honest observation is, I think Pecha Nikolova and her team are exceptional. I think Pecha is probably one of the very best infrastructure investments in the marketplace. And I'm not just saying that. She's not here.
Right.
She might be listening.
That's why I'm bringing it up.
She is exceptional, and her performance has been, consistently 200 basis points above her peers. And the fact that the board has also given her authorization to pursue co-investments. Co-investments different. We do co-investment public for private equity. It goes into a sidecar, and it's a mix, it's a blend of co-investments that the GP decides. With the infrastructure co-investments, Pecha actually underwrites all that, uses her investment banking background, and does all that due diligence herself and underwrites those deals.
Question about the previous slide with the fees. All right?
Yeah,
So we paid roughly $51 million in fees for this. And that's roughly less than 1% of the assets of the manager.
Yeah.
Is that kind of like the going rate?
I don't think so. I think, my honest assessment is I think they're high.
Think they're high?
Do a better job. If you look at.
The reason why I bring it up, though, is I just hate to be penny wise, dollar foolish.
Yeah.
If we're gonna, go to someone else to cut fees and they don't perform as well,
Yeah.
that could hurt the fund.
Yeah, so Artie, what we need to do is we need to give you the information to make those informed decisions. So we're trying to develop analytics that actually show the excess return of the alpha that's generated per unit of fee. And really, it's all about, and you're absolutely right, if you're paying 1 basis point in fees and you're getting 5 basis points in extra performance, that's worth it.
Yes.
If you're paying 1 basis point, if you're earning 1 basis point in fees and you're paying 1 basis point or 2 basis, it's not worth it. So that's usually, let's say you're paying fees on a mandate that charges 10 basis points in fees. Your typical alpha return or the excess return that you generate is, it's 3 or 4 times that. It's 30 or 40 basis points. What we're doing is, and Ed's done a lot of really good work working with John Merceburg, who's developed analytics that actually track all that. And actually look at, well, you generated 15 basis points of excess return on a net basis, but you're paying 15 basis points in fees. That's not a great value proposition. So I need to do 2 things. Change the construction portfolio, or 3 things, pick different managers and negotiate fees lower. And we just hired an attorney, that's gonna report to Lynn Fleischman, our Chief Operating Officer, indirectly to me. And that one of his main functions is to renegotiate fees consistently. So we have an RFP process for public markets. We go through this process, we hire a manager. I hate to tell you, those are typically 8-year contracts with 2 one-year rights of extension. We oftentimes have not gone back and renegotiated fees lower. It's not just that the market changes and fees can gradually come down. It's also gotta be, you have to be tracking their performance. You said you're gonna deliver 40 basis points, you're delivering 10 basis points. I'm paying you way too much in fees. Even if it's a net positive return, it's what are you paying for that? So we're trying to develop analytics for, the value you get per unit of fee for both public, private. It's hard because they're chunkier, the way that the income streams work are very different. But we actually think that that's something that the trustees should know when they make decisions, and we should come with solutions. So I know, Rob, you've been working with Ed and John Mercersburg and Robert Feng about systematic, about a way we can reduce the exposure to, and I know we're in a public forum, so I hate to say this, but I'm always skeptical about the ability for active managers to outperform, particularly in public markets that are efficient. So if you look at your U.S. equity allocation, 70% of that is passive. And the question is, are you getting value for the other 30%? I can show you a slide that demonstrates we're not getting the benefit, and that's one of the biggest slices of your portfolio. We think there's a better way to do it. So it's passive, core, it's systematic, non-core, and it's going to be active. Still may make sense, but a smaller allocation, more concentrated bet.
Thank you.
I'll just make the point that what we see as the final negotiations where basically BAM has gone to a manager, taken the nickel, bent it so much that, Jefferson is crying on there, and then they come to us and present us with fees that they have negotiated as best as they possibly can before it comes to the board. With enhancements that we presented to the board, that hopefully get addressed by the end of the year, we think we can do it. I don't want to speak for BAM. As a reminder, I don't represent BAM here, I represent the controller, but it's part of the controller's office. I think that as a trustee, the enhancements that we've put forth or that BAM has put forth to the board, if those were to be wholeheartedly adopted by all of the retirement systems, I think that would provide a strong ability to BAM to run the analytics, to get the right people in place in positions where they have that skill set, and add enhancements to the existing infrastructure of BAM and personnel in BAM in order to help ultimately drive down fees, understand where it's coming from, and a way to extract the best value for the fund. So I think that we have seen the benefits of what BAM does as the low fees that come in, but I think that there is an ability that the boards can take, an action the boards can take at some point that would only enhance their ability to do that. So that's a little plug for other initiatives that we have in the hopper that we presented throughout the last year. So I just want to make that, I just want to draw those together because they are together in what they're trying to accomplish.
We're actually making great progress on understanding the performance at a really deep level. Again, there's a reason why I've asked Ed to kind of move over from being the Chief Risk Officer, head of public markets. It's the analytical tools that he's built up that are really, really insightful that nobody else has. Yeah. It's also all the State Street data. It's specific to each of the managers. So we're much better able to, and it's actually ongoing over the last 6 months when we sit down with the managers now. We have a one-pager that looks at all the different analytics and metrics of their performance, and it looks at how they're managing their assets, what the bets look like, what the fees are, and what the return is relative to expected returns, and we're holding them accountable. And I can't say it in this forum, but we have been successful where we go back to the manager and say, okay, you said you're supposed to deliver 40 basis points, you delivered 10. We're paying you something that's above 10. We want you to reduce your fees, and they're willing to do that. And if not, we'll come back to you and ask for guidance about, we think we need to fire a manager because the performance isn't what it was expected to be. So we're doing that, as I said, we need to give you more insights. I appreciate the question on the slide, but this is, all right, great, I paid, $12.9 million for the third quarter, what does it mean? We need to show you trends, what are we doing to help you reduce the fee burden?
Yeah.
But you're absolutely right. If I'm spending money on fees, I want to make sure we're getting good value. I think you get better value in private markets. And again, we need to get those fees down too. But I think you get better value in private markets relative to public markets for academics.
So,
What's the response there?
so, look, anytime between meetings, I know Wilshire's always available to take trustee calls, Pam is willing to take trustee calls. And I would encourage folks that when you have a question, ask. And truth be told, I'm sure I'm going to be compelled at some point today to ask somebody about explaining why their fee is what it is. It's things that we should be doing as a board. It's not to shame anybody for coming in with a high fee, but it's incumbent on us to ask those questions of managers and to make sure that the members and the beneficiaries of this fund are getting the best deal possible.
We did add a slide to the packet that actually shows for each of the private market deals, it shows the economics relative to your portfolio now, the industry, and it hopefully demonstrates the co-investment. And this is actually, if you looked at these slides, we should be demonstrating that we continue to average down the fees for your portfolio every time we do a deal. Or if not averaging down the fees, making sure that the performance will be there by having the right best manager. So that's part of it. There's a method behind this madness of trying to give you more information.
So, thank you, Steve, for your commentary. Before we go into executive session, I would like to take a moment of personal privilege to just make an acknowledgement. We've already acknowledged that one member of somebody in the boardroom today is here for the first time. And I just wanted to point out, and I know Kevin's pointed this out at the regular meeting, but today is Nicole's last meeting as the general counsel of the police pension fund, a job that she's done better than most have, and better than everybody else has, in my opinion here. I really think that you've been a true professional. I think that, I always say the most unfortunate thing about civil services, the members and beneficiaries will never know the impact that you alone had on their lives, the policies that you've created, the way that you've helped interpret the law, the way you've helped guide this fund, the way that you've taken documents from 1940 and updated them so that we actually have a 2 in front of it, and we've done it in the 2000s instead of in the 1900s. You've done it with wit, you've done it with smarts, you've been a pleasure to deal with. And, for me personally, you're one of my first calls when I'm trying to figure out something in the pension world that just doesn't seem to make sense.
And you still will be.
And you still probably will be. And, and I think that a lot of things have been said and will be said for probably the rest of the day, in the next 2 days. But, this is the last time that we're going to see you in this setting. And just wanted to take that opportunity to say, thank you. And, I appreciate it. I'm sure everybody else does. As the dean of the city-side delegation, I thought that it would be appropriate to just make that acknowledgement before we go into executive session. I don't know if anybody else wants to say anything, but I just wanted to put that out there and let you know that we appreciate the work that you did. We appreciate you.
Thank you. I certainly have appreciated working with you over all of these years. Thank you for that.
So.
Thank you, everyone. It has been such an honor to sit at this table, at the banquette behind the table, learn from everyone here, and to serve the finest. So thank you.
Good luck.
Thank you.
And John, who made you the dean?
I'm here the longest.
Self-proclaimed.
Yeah.
Exactly, that's.
Yeah, I said of the city-side delegation.
Self-proclaimed.
All right, so if there's nothing further, I'd like to make a motion to exit executive session. Exit public session, enter into executive.
And the PBA would like to second that motion and get the show on the road.
Okay. And I would just ask that a copy of the to exit executive session, enter into public session. Okay, we are now in public session. Will Bam please turn on the camera? Okay, I believe the recording is on, so, is there a report out?
Yes, in executive session, the trustees heard presentations from the Bureau of Asset Manager, the Bureau of Asset Management, its managers and consultants in the asset classes of infrastructure, alternative credit, and real estate. Decisions were made. Those decisions will be made public at the appropriate time.
So before we go, I just want to say congratulations on your next endeavor, Nicole.
Thank you.
And with that, I will make a motion to exit, motion to adjourn. Is there a second? How did you?